All right, good morning, everyone. Hopefully, you're having a fantastic Saturday. I am Derek Clifford. I'm the founder and CEO of Elevate Equity, and I'm so glad that you're here with us this morning. Today, we're going to be talking about a very interesting topic that's pretty much the one of the most essential concepts to grasp when investing in real estate, and that is the capitalization rate. I'm sure many of you guys who've started to explore this world of real estate investing, whether you're looking in the single family route or in the multifamily route, you've been seeing this term come up over and over again. And usually there's a formula associated with this. It's the cap rate. And we're going to dive into that a little bit today. We're going to do a little bit of examples on what it looks like for single family homes and why it's important. And then the same thing for apartment buildings. Okay. And let's just back up a little bit and talk about what a cap rate is. It's basically just a simple ratio that explains the net operating income versus the value of the property itself. Okay. And by looking at that cap rate and this ratio, you can determine the health and the performance of the property or the investment that you're about to get yourself into. Because if the capitalization rate is really high, then that means that the amount of money that you're putting in to purchase the property is going to fetch a higher return, okay? And if it's really low, then it's going to be the opposite. It's going to be a much lower type of return for the cash outlay that you are putting in. And the nature of cap rate is really cool because it's universal. So if you have an apartment building, or if you have a business that you may want to buy, or if you just have a simple stock, anything out there, anything that's got an investment that has a value and has a cash return over time, you can measure it and compare them using what's called the capitalization rate. It basically lets you determine, all right, for how much money I'm outlaying, how much money am I getting back in return? And then there's some really interesting dynamics at play that will end up taking hold when you're on the purchasing side of that cap rate or when you're on the selling side of that cap rate. So we'll get into that just in a little bit. So I just wanted to touch how important this is. This is one of the most essential topics for investors to understand. And so what we should do is we should just jump into it real quick and give you guys the formula for how it works. And then we'll kind of break it down and we'll go a little bit deeper to try to understand how it all works in the form of real estate investing. So I'm going to go ahead and share my screen. And so you guys should see on the screen a formula. It's net operating income divided by the current market value of the asset. Net operating income is pretty simple to calculate. Whatever your investment is, whatever cash it's throwing off as a net, right? In real estate, we have things called expenses that come in. So we collect our rent and then we have to pay all of our expenses, but not the debt itself. So what I mean by net operating income is you have to pay the property taxes, you have to pay your property manager, you have to pay for repairs, insurance, all of those things that come in on the top of the line, right? Before debt is applied, that's the net operating income. And that's very important to exclude the debt because that's the only way that we'd be able to compare apples to apples and investment to investment, okay? And then the current market value of the asset is at this moment in time right now, how much is that asset worth? If you have a property, right, that's throwing off, let's say $100 per month, but the purchase price of that property is $100,000, that would perform a little bit differently than if you bought that property with the same amount of profit coming off $100 per month on the net operating income. If this was only $50,000, right? So that ratio would be much, much different. And so with $100,000 in your pocket, you could buy two of those ladder homes that we were talking about versus one of the other one. And so you'll be fetching much more of a return on the operating income for the outlay that you are putting into the property, okay? Just to go one step further, this was a really cool graphic that I found online, and you could probably find this too if you Google it. But essentially, cap rate is what we just talked about. It's the net operating income divided by the price, the current value of the property. That'll get you what's called the cap rate ratio. And what they're basically trying to describe here in this complicated looking section of the graphic is in order to determine the value of a building that maybe you're looking to purchase, you can take the cap rate, you can calculate what that is by using a bunch of different comparable properties, right? So whatever they sold for, whatever their income is, you can get that information online. And then you can calculate whatever the cap rate should be for the market, okay? Those are comparable sales. You use that cap rate to help figure out whether or not the property that you're purchasing right now is going to be a good deal, what is the fair market value of a property that you're going to buy. Or if you're selling, what do I price it, right? So you look at whatever the expenses are and the income, and then you can use the cap rate. So you reverse the formula, right? You just change it around, do some algebra from the high school days, and you can move the cap rate around so that your net operating income divided by your cap rate is going to be equivalent to the value of the building. Whether you're buying or selling, that would be the fair market value. Okay, and so as a seller or buyer, you can use that value evaluation to help determine whatever you would like to establish to the seller or to the buyer, depending on which side you're on. Okay. Hopefully I haven't lost many of you guys, but just wanted to stress how important this is, because it essentially, you're rolling up an entire market dynamic in a certain area and asset class into one number, into a ratio that you can use to apply to the rest of the market. Okay. So that being said, why don't we go ahead and jump into a really quick example to calculate this. Okay. So there's a lot of ways to do it. I think what I'm going to do is we're going to start with the single family. So here is a single family property in Indiana, in Indianapolis. That's one of the markets that I really like to participate in. And let me make this a little bit bigger as well, so you guys can see it nicely. So there's this house, and let's say that the purchase price is about $135, and we're going to be going into it with about $10,000 worth of rehab and $135,000 purchase price. So our total cash outlay is about $145,000. We're going to be financing it, so we're only putting down about $38,000, and then if the after repair value is less, but this is a buy and hold, so we anticipate appreciation, then we can expect to have rental income of $1,200, and then given all these expenses, right, we can come up with an NOI, or not net operating income. That's the income minus the expenses, of about $700 per month. With that $700 per month, you have to adjust it to an annual basis. So let's get a calculator out here. Okay, so we're going to pull up the calculator, and so we have the $708 per month times 12. That's per year, right? So this is how much cash we're going to be expecting to get out of the investment, divided by, because remember the ratio, that's what we're looking for here, right? So if we go back to this formula and we go back to the simplified one, it's a net operating income, which is the annual net, that's 708 times 12, that's 8496, divided by the current market value of the asset. That would be currently what we paid for it, right? So if you divide that by 134.9 plus $10,000, that's the current going rate. That would be 144.9. You get a cap rate of about 5.82. Okay, that means that in this neighborhood, you should expect to pay a certain amount, right? You should be able to, you should be able to say, all right, well, this property isn't fetching that much income for it. Okay. If the rentals in the area are actually at a lower or higher cap rate, then that can tell you a little bit about where the purchase price is, right? Because if the cap rate is higher, right, then that means that you're getting a really good deal. Whatever you're purchasing, you're getting more returns for your outlay. If it's lower, then that means that maybe the property is overpriced a little bit and you're not getting as much outlay, or you're not getting as much cash for your outlay. So you can kind of use this to help gauge whether or not whatever property you're buying is actually a good deal. Okay. So hopefully that's helpful to you on this. If you guys have any questions, feel free to shoot it in the comments, and then I'd be more than happy to help you out there as well. So let's just see what happens if this number ends up changing though, right? Let's say that instead of $1,200 a month, you actually are able to get $1,300 a month. How would that change the numbers? So we go from having a I think it was a 5.8 cap right here, right? 5.8 cap. Let's try it over again. So now we have $782 per month of income. And then on an annualized basis, that's $93.84. And let's divide that by the same number, which is 1,459.00. That gets us a 6.4 cap. Okay, so that makes a pretty big difference. If you have a $100 more per month, that'll get you a 6.4 capitalization rate. Okay, so you can say that in this neighborhood and in this area in Indianapolis, generally, if this is true, or if you're getting $1,200 a month, that the cap rates tend to run somewhere around 5.5 to 6.5%, right? 5.8 to 6.4. That's if all of these numbers are true. And you can use that to help determine whether or not a purchase of a property is a good deal or not, okay? So that is how it works for single family. Now, what I want to do is I want to try to go over to multifamily as well. And for this one, I'm going to show you guys, because I already have a picture from my book that I'd be happy to share with you. Consider a 100 unit apartment complex. It's really not much different than a single family house, okay? In this case, let's say we have 100 units and they're renting out for about $700 per door. And if the potential income is $840,000, and then you have expenses and vacancy adding up to about 440, that leaves about $400,000 in net income to pay off debt and to return to the investors, okay? So in order to determine what the cap rate is, we can do that by going to our calculator again. I'm gonna go ahead and clear this out. And we can say, all right, well, if the net operating income is 400,000, right? We will divide that by the cap rate, which would be, let's say, 0.55, or I'm sorry, 5.5%. That'll determine the value for us. So we just switched around the cap rate and value, right? So if you do that, oops, let me say this again. So $400,000, and then you divide that by 0.055, that'll get us a value of about 7.2 million. And so if we ended up purchasing this property for $7.3 million, then that would reflect a 5.5 cap, which may or may not be in line with fair market value inside of that market, right? But if we end up like overpaying, right? Let's say that we end up buying the property for 8.5 million, okay? And then we want to find out and then according to the net operating income. So if the net operating income is the same, so $400,000, and then you divide that by the 8.5 that we're going to pay, is that a fair deal? Well, we'd be buying it at a 4.7 capitalization rate. And if the market is going at 5.5, then that tells us that this is probably overpriced, because we're paying much lower, or we're paying much higher outlay for the net operating income that we're getting based on the comparable sales in the area, okay? So that's on the acquisition side. And then one last thing I want to show here before we can put all the numbers away and we can talk high level again, is what happens if you end up buying this apartment building, and as you hold it, or if you have a house, right, and you hold it and you're able to increase the income in the building, right? So let's take a look at what that looks like on paper. So here, let's say you hold it for 3 years, you execute your business plan, like you add a dog park, you upgrade the kitchens, you have better marketing, you get a better team in place to be able to jack up the profit. Now for the same 100 units, you're going to be getting $775 in rent for each one. That means that your net operating income is now going to be a little bit higher. And in this case, it'll be $470,000. So if you take the same cap rate that you used to buy the property, which in this case, we're going to just assume a 5.5 capitalization rate, so 5.5%. What that does to the value, let's try this again, right? So again, at $400,000, right, if we divide that by 0.055, that means that a fair market price would be $7.3 million, okay? So let's try this again with that same cap, okay? But now with a little bit higher income. So now we have $470,000, right? And then you divide that by the same cap rate that you purchased it at, okay? That means that you have now $8.5 million building. So considering that we bought the building for 7.2, you can expect to fetch 8.5 million. So so now what the cool thing is like, where did that 1.3 million come from? Well, you created it by increasing this net operating income up, right? You've created $1.3 million that you can refinance or pull out in terms of cash, okay? So this is a really, really big deal. And this is how apartment investors make their money, and also how single family home individuals also make their money, but much to a lesser extent, because the way that the valuations and banks work, it's a lot different, okay? So I thought I would pass that along here. Hopefully this was a little bit useful to you. And if it's confusing, let me know. I'd be more than happy to sit down and talk this through with you a little bit more. And then the last thing I want to mention here too is that usually when you hold a property for 3 years, right, and you end up improving the value of the property by so much, you can compress the cap rate. So the building itself is now a nicer product, so investors are willing to pay more for it. So the cap rate will shrink because now the comps for that apartment building is much different. Because if you had a really shoddy building that you bought and it was kind of a POS, right? And you went in there and you injected a whole bunch of capital and made it so much nicer. Well, now you've made it more desirable. So now the comps that are used to compare that building for cap rates is different. So if the cap rate shrinks, and let's just say that it shrinks 0.5%, right? So let's say that you have the $470,000 in income that you created over the last couple of years, right? That's the new annual net operating income. If you now divide that by 0.050 instead of 0.55 to pay a 5.5 cap, now you're paying a 5 cap, right? Now your building's value is 9.4. So you bought it at a 7.2 and now it's worth 9.4, which means you've created over $2 million in value, right? By increasing the desirability of the building. All right. So hopefully that was useful to you. That's pretty much how it all works. Let me go ahead and switch back to me. And the basic gist of all of this is cap rate determines desirability. In California, very, very low cap rates. Even in some of the worst properties in some of the worst neighborhoods, they're comparably low compared to somewhere else in the Midwest, right? So every market and every asset class has its own fair cap rate and fair going rate. So in general, low cap rate is very expensive when you're buying, but it's also desirable. So there's a chance that there could be more appreciation in the end, right? High cap rates is very cheap when you're trying to buy. But when you have a high cap rate, it could be risky or in a less desirable market. So you may not actually get the benefit of appreciation. It may just be all cash flow. You may buy it for $50,000, try to get as much cash flow as you can because it was a cheap product, right? And then in the end of the 3-year hold or however long you hold it, you're just trying to get your original capital back because it's still not in a desirable area. Where you can really make money and things that I look for in Elevate Equity whenever we're buying and selling apartment buildings is we look for a little bit of both of those effects. We try to find a very high cap rate property that's desirable at the buy, right? So it's a very cheap purchase price for the income that we're getting, but we also watch the gentrification or we watch the path of progress move towards the building. Then the market cap rate will push down naturally. And then of course, we're also injecting capital and making the building a nicer place to live. And so that will also push the cap rate down, which means the value will go way up, right? Because remember, it's a ratio, NOI divided by the fair market value of the building. So if the cap rate is the same and the net operating income is, I'm sorry, let me say that again. If the net operating income is the same, but the cap rate goes down, then the value of the building has to go up. And so as you buy properties in areas where the path of progress is moving towards, cap rates start going down because they're more desirable. And so the values just go up a lot. And if you can increase your net operating income and decrease cap rate, your profit goes through the roof. And that's exactly what we look for when we start buying apartment buildings, okay? So anyway, that's a little bit about cap rates. Again, last thing I'm going to say, each market's different. They have their own capitalization rates, but it's really important to understand how it all works because it'll help you gauge the performance of your investment and benchmark your investment versus any other investment because it doesn't consider any financing at all. It's all cash-based assumptions, right? So just looking at the pure market dynamics of how much someone is willing to pay versus how much income it's throwing off without considering financing, that's a fair benchmark price to assume one investment to another. And hopefully you can do that. If you need help calculating cap rates for a market, let me know. There's pretty easy ways to do that. There's automated calculators out there, but it always makes such a big difference for you to understand what's happening behind the numbers and not just understand the formulas, but understand what that does, right? And how you can use that to your advantage as a sophisticated investor. So anyway, hopefully that was useful. We hope that you enjoyed this broadcast of Elevate Your Equity for your live stream. And if you want more information, please look us up on elevateequity.org and feel free to listen to us and download our podcast. It's called Elevate Your Equity, and it's available everywhere where you have podcasts or where you listen to them. And we're also going to be posting this stream on YouTube for you to view later if you want to, along with all of our other Saturday streams. And if you want more information, feel free to reach out to me. Head over to our website, schedule time to talk with me. If you want to talk strategy about how to get started, we're here to help you. All right. So anyway, with that being said, I'm going to let you resume the rest of your weekend. Great talking to you all, and hope you have a fantastic evening. Take care. Bye-bye.